The moment you drive a new car off the dealership lot, it loses money. Not in a year, not in a month. The second you leave, instantly, and that's just the beginning. Most people think a car loan is just a convenient way to pay for something they need, a practical decision, a normal part of life. What they don't realize is that a car loan, especially on a new car, is one of the most expensive financial decisions most people will ever make, and almost nobody does the math before they sign. Today, we're going to do the math, every layer of it, and by the end of this video, you'll never look at a monthly car payment the same way again. Let's start with the numbers. Because before we talk about how the system works, you need to understand how deep in it America already is. Americans currently owe $1.667 trillion in auto loan debt. That's trillion, with a T. It's the second largest category of consumer debt in the country, behind only mortgages, bigger than student loans, bigger than credit card debt, bigger than medical debt, and it's growing. 10 years ago, in the fourth quarter of 2015, Americans borrowed $131.5 billion in new auto loans in a single quarter. By the fourth quarter of 2025, that number had risen to $180.8 billion in one quarter, just in new loans. The average new car loan right now is $43,582. The average monthly payment on a new car is $767. And the average loan term? 68.9 months. That's nearly 6 years. 6 years of $767 a month. Do that math. That's over $52,000 on a car that started losing value the second you drove it away. And that's just the average. If you have anything less than excellent credit, your interest rate jumps dramatically. Borrowers with poor credit scores are paying used car loan rates of over 21%. The people who can least afford expensive financing are being charged the most for it. That's not a coincidence. That's a business model. So where does all that money go? And why is the car loan specifically such a bad deal compared to other forms of debt? There are 4 reasons, and they stack on top of each other in a way that most people never see until it's too late. Here's something the dealership will never put on a poster. The moment you sign the paperwork and drive off the lot, your brand new car loses roughly 10% of its value immediately, just for being driven, just for going from new to used in status, even if you've owned it for 40 minutes. By the end of the first year, that car has lost about 20% of its purchase price. Buy a $40,000 car today. In 12 months, it's worth $32,000. You've lost $8,000. You didn't crash it, you didn't neglect it, you just drove it to work every day, and $8,000 is gone. But it doesn't stop there. New cars lose about 30% of their value in the first 2 years. After 5 years, roughly the average loan term, most cars are worth around 40% of what you paid for them. Think about what that means in concrete numbers. You buy a $43,000 car. You make payments faithfully for 5 years. At the end of those 5 years, your loan is paid off. You own the car. But the car is now worth maybe $17,000. You paid $43,000 plus interest. You have something worth $17,000. That's a $26,000 loss before you count a single dollar of interest, insurance, fuel, or maintenance. And here's the part that makes this genuinely dangerous. In the early months of your loan, you're losing value on the car much faster than you're paying down the debt. Depreciation moves faster than amortization. There's a term for the result, negative equity. Dealers call it being upside down on your loan. It means you owe more on the car than the car is currently worth. This is not a rare situation. It's extremely common, especially when loan terms are long and down payments are small. Studies suggest that at any given time, around a quarter of people trading in a car are upside down on their previous loan. And when you're upside down and something goes wrong, you total the car, you lose your job, you need to sell. You're stuck. You owe $35,000 on a car worth $28,000. You don't have $7,000 sitting around, so you roll that negative equity into your next loan. And the cycle continues. Now let's talk about the interest, because this is where the quiet, consistent drain really lives. The average new car loan interest rate is around 6.37%. That sounds reasonable in isolation, almost harmless. But let's translate it into actual dollars. Take that average loan, $43,582, at 6.37% interest over 69 months. By the time you make your final payment, you'll have paid roughly $9,000 in interest alone, on top of the purchase price, on top of taxes and registration fees, on top of insurance premiums, on top of the depreciation we just calculated. $9,000. For the privilege of borrowing money to buy something that was simultaneously losing value every single month you held it. And remember, that's the best case scenario. That's someone with good credit getting a new car at a competitive rate. If your credit score is in the subprime range, which describes tens of millions of Americans, the numbers get brutal fast. Used car loan rates for borrowers with poor credit can be 16%, 18%, even over 21%. At 18% interest on a $27,000 used car loan over 67 months, you're paying close to $16,000 in interest. That's more than half the purchase price of the car itself, in interest, on a used car. Now here's the detail that almost nobody understands, because banks certainly don't explain it clearly. In the early months of your loan, almost all of your monthly payment goes toward interest. Almost nothing goes toward the actual principal, the amount you borrowed. This is called amortization, and it's how all installment loans work. Here's what it looks like in practice. Month 1 on a $40,000 loan at 7%. Your payment might be $700. Of that $700, roughly $233 goes to interest. Only $467 actually reduces your debt. The bank collects its money first, every month, without fail, for years. By the time you're in the later years of the loan, when the balance is smaller and less interest is accruing, you've already paid the bulk of the interest charges. This structure is not accidental. It's mathematically designed to ensure that if you pay off the loan early, the bank has already collected most of its profit. And if life happens and you miss payments or refinance, the bank hasn't lost much. You're paying $700 a month. The car is losing value, and the first 2 or 3 years of payments are mostly filling the lender's pocket, not building your equity in the vehicle. This is the system working exactly as intended. You survive the depreciation section. You survive the interest math. Now for the part of this story that most people never see coming, because by the time it happens, they've already mentally bought the car. The finance office. You found a car you like. You've spent 2 hours negotiating the price. Maybe you even did well on that part. You're tired, but you feel good. The salesperson says, "Let me just walk you back to finance to sort out the paperwork." This is where a significant amount of additional profit gets extracted. The finance manager is not there to help you complete your purchase. The finance manager is a trained salesperson whose entire job is to sell you products and financing terms that maximize the dealership's back-end profit. They are very good at it. The list starts: extended warranties, gap insurance, paint protection packages, tire and wheel coverage, credit life insurance, interior protection plans, key replacement programs. Each product sounds reasonable when described with the right tone. Each costs somewhere between a few hundred and a few $1,000s, and each gets offered to you in the form of a monthly payment impact. This extended warranty would only add $18 a month to your payment. $18 a month sounds trivial, but $18 a month over 72 months is $1,296 plus interest, because that cost gets rolled into the loan. A $1,500 extended warranty financed at 8% over 72 months doesn't cost you $1,500. It costs you closer to $1,900 by the time you've paid it off. And here's the thing about extended warranties on new cars. The manufacturer's warranty already covers your vehicle for years. In many cases, the extended warranty you're being sold duplicates coverage you already have and is loaded with exclusions that make it very difficult to actually use when something goes wrong. Gap insurance is the one product in the finance office that can genuinely make sense. If you have a long loan term and a small down payment, gap insurance covers the difference between what you owe and what the car is worth if you total it. It's a real product with real value. But through a dealership, it typically costs $600 to $900. Through your regular car insurance provider, the exact same coverage costs $150 to $400. Then there's the interest rate markup. This one is almost invisible. Dealerships have relationships with lenders, banks, captive finance arms, credit companies. Those lenders approve borrowers at a certain rate. The dealership then has the ability to quote you a higher rate and keep the difference. If the lender approved you at 5.5%, the dealer might quote you 7.5% and receive a portion of that 2% spread over the entire life of your loan. This practice has been challenged legally over the years and is more regulated than it used to be. But it still happens. It's disclosed, buried in the fine print, and almost no one catches it in the moment. By the time you drive off that lot, between price, add-ons, rolled-in products, and a marked-up rate, you may have paid thousands more than you thought you were paying. And it's all spread across 72 monthly payments, so the damage is invisible in real time. Here's the most sophisticated layer of the whole system. It's not the interest rate. It's not the finance office. It's something more fundamental, the way the entire industry has trained you to think about car purchases: the monthly payment. Dealerships figured something out a long time ago. People don't think in total prices. They think in monthly payments. The moment you walk into a showroom and say, I need to stay around $600 a month. You've handed the dealer all the control they need, because any number can be made to fit $600 a month if the loan is long enough. Want to put a $55,000 truck within reach? Easy. 84-month loan, 7 years. Your payment is manageable. The total cost is catastrophic. 84-month loans, 7 years, are now common. 10 years ago, they were rare. They didn't proliferate because consumers demanded them. They proliferated because they make expensive vehicles feel affordable while dramatically increasing the total interest collected. A $45,000 car at 7% over 84 months. Your payment is roughly $680. That feels okay. But total interest paid over the life of that loan exceeds $12,000. And by month 24, that car might be worth $30,000 while you still owe close to $37,000. You're deeply upside down for years. There's another dimension to this that psychology researchers have studied extensively. When something is broken into small recurring payments, people systematically underestimate its total cost. It feels less real. A $45,000 purchase feels enormous. A $680 monthly payment feels manageable, even though they're the same thing expressed differently. The car industry didn't stumble into this insight. It was deliberately built into the sales process. Train customers to negotiate payments, not prices. Control the loan term, control the rate. The sticker price becomes almost irrelevant. Car companies know this, dealers know this, lenders know this, and now you know it too. There's one more thing we need to talk about, and it's the most invisible cost of all: opportunity cost. Every dollar you spend on a depreciating car is a dollar that isn't building wealth somewhere else. Let's run a simple scenario. The average new car payment is $767 a month. What if, instead of financing a new car, you bought a reliable 3-year-old used car, paid much less, and invested the difference? Say you free up $500 a month. You put it into a broad index fund. Historically, the U.S. stock market has returned around 7% annually on average over the long term, adjusted for inflation. $500 a month at 7% annual growth over 10 years becomes approximately $86,000. Over 20 years, that same $500 a month becomes roughly $260,000. You didn't have that money sitting in a savings account. You were spending it anyway. The only question is whether you spent it on a depreciating asset or let it compound into real wealth. The car you bought in year 1 is worth 40% of its original value by year 5. The portfolio you didn't build has grown. That gap between those two outcomes over decades is the true cost of the car loan decision, and it rarely shows up in any conversation at the dealership. Now, this isn't an argument for never owning a car. Cars are necessary for most people. The argument is about how you own one and at what price. The difference between financing a $43,000 new car on a 72-month loan versus buying a solid 3-year-old used car for $22,000 isn't just $21,000 in sticker price. It's also thousands less in interest, depreciation already absorbed by the previous owner, and freed up monthly cash flow that can actually grow instead of disappearing into loan payments. The system is designed to keep you in a cycle. Buy new. Finance long. Trade in early while upside down. Roll the negative equity into the next loan. Start over. The average American trades in their car every 6 years, which means most people never reach the point of owning something free and clear. They trade before the loan ends, or take on a new loan the moment the old one is paid off. You never stop paying. You never get ahead. You just keep feeding the machine. So what do you actually do with all of this? First, if you can buy used, buy used. Let someone else absorb that brutal first-year depreciation. A 2-year-old car with 25,000 miles is not a worse car. It's a dramatically cheaper one. Second, never negotiate on the monthly payment. Always negotiate on the total price. Then calculate the full cost yourself. Payment times number of months plus your down payment. That number is what the car actually costs you. Third, get pre-approved for financing before you step foot in a dealership. Go to your bank. Go to a credit union. Credit unions typically offer better rates than dealerships. Walk in knowing your rate. Then you can't be upsold on financing you didn't agree to. Fourth, say no to every product in the finance office. All of them. If you decide later that you want gap insurance, call your car insurance company. You'll pay half the price. Fifth, think hard before buying new at all. The person who buys a 3-year-old Toyota with 30,000 miles for $18,000 and drives it for 8 years will, over a decade, spend dramatically less and lose dramatically less to depreciation than the person who buys new every 6 years on a loan. And sixth, understand the monthly payment trap before you walk in. Decide your maximum total price before you start shopping, not your maximum monthly payment. Your maximum total. Write it down. Don't move from it. The car loan is not a neutral financial tool. It is a product engineered by some of the most sophisticated financial minds in consumer retail, designed to extract maximum value from a transaction while making the cost feel invisible through monthly installments. The dealership, the lender, the finance office, they all make more money the longer your loan, the higher your rate, and the more products they can fold in. You make more money by understanding exactly how the game is played before you sit down at the table. Now you do. Subscribe, because on this channel, we keep breaking these things down, one system at a time.